Good morning. Time to pop a poll. What are you trading today? Risk on, risk off, add option, risk neutral. Boom, shalakalaka. You guys about ready to go? All right, then we'll get going. Let me mark this as the start. All right. Good morning. Comment allez-vous? How are you? Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Because trading is risky, not appropriate for everyone, your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. I've been trading for about, 20-something years? Yep. Before that, I was a venture capitalist. Before that, I was a high-tech entrepreneur in the Silicon Valley. Before that, I worked in the nonprofit world and actually still do. And my colleagues were the likes of famous and powerful people. We'll just leave it at that. Nice. All right. So what do you want to do today? Gold, oil, Bitcoin, dollar pairs, yen pairs, stock market? Cool. We'll do that. If you want me to cover something else, you're like, I want to do Ripple. XRP, baby. We can do that for you. Just speak up and ask. While you're here, make sure you click the thumbs up button. Tell YouTube this is quality content. That is my goal. I am here to serve you. I am a humble servant. My background, formally, I have an education in macroeconomics. I've passed the Series 3, which is the National Futures Association and Commodities Trading Commission's professional examination on fundamentals. So I know a little bit on the fundamentals side. Having traded for 20-something years, I gotten pretty okay on technical analysis. So we could do all of that if that's what you want to do. But if you want to talk about how to set up a hedge fund or raise money or talk to a client or whatever, like, dude, seriously, we can do that. So let me know. This is your hour of power, so you're going to have to speak up quickly and soon. We all need a broker. There's two different business models for brokers, A booking and B booking. B booking means they put all their clients into a bucket, and they assume everybody in the bucket will lose money over time. It's like a casino. As long as they can keep you there, you're going to lose your money. That's how the business model works. Now, if you're in a casino in Vegas and you start winning a lot, what happens to you? They kick you out. So that's the traditional model with a Forex broker, where they want you to lose money. And, well, if you start making money, they'll find a way to get rid of you. Now, on the flip side, there's another model based on ethics, and that is to develop a symbiotic relationship with you. And that's a fancy way of saying if you win, they win. If you're happy, they're happy. So they want to make you happy, and they want you to succeed. And that's a completely different business model. You're only going to find that through an ECN. Now, Trader's Way is not the only ECN in the world. There's not many of them. But an ECN it's an old term, but it tells you the business model. And it uses straight through processing, right? So there are a few ECNs, not many, there are a few. I recommend Trader's Way. So start there, do some due diligence, open up a demo account, and I think you'll be very pleasantly surprised how clean and organized the back office is and all that kind of stuff. So go check them out. Now, the value ladder continues here. We all need education. Okay, I run Investor Bootcamp. There's 100 hours of training videos. Great. That's $88 a year. Super ridiculously cheap. Cool. And then from there, if you like what we do, maybe you want to join a live group. And we have two live groups. Two live crew. We have two live crews. And there they are. One is $99 a month. We meet Tuesdays, Wednesdays, and Thursdays now. And then the day trading group. Okay. They're good. Cool. And if you're a day trader, you get everything in the swing trading. So we've expanded all that and then kept the prices the same. And it's getting better and better every year. Then we automate our fundamental analysis using QuantBox. It's incredible, the amount of research that it does. But the thing is, it very easily and clearly cuts through the noise. And then TRADARS is a new service that I launched a few months ago. And I have huge plans for it, so you really do need to get involved. And QuantBox only does fundamentals, right? Right? Only does fundamentals. TRADARS only does technicals. But it does technical analysis for you. It's trend agnostic, which means it doesn't care what the trend is. It doesn't care what the bias is. That's not what it does. It simply looks for 12 patterns on 7,500 charts. And when it sees a pattern, it'll tell you. It's not an alert service because, well, you know, let's find a pattern that probably doesn't make sense. Let's see one here. Well, all of these make sense. Well, you'll get scenarios, and I don't see something that doesn't make sense. Well, I guess this one. Okay, pound yen. It says down. It noticed a channel up on the 4-hour chart, and currently it says a modest down. Stewie says, how much is TRADARS? It's $1 million a year. Okay. And then you also are required to adopt a puppy, love it and take care with it, and then bond with it, and then give it back. Yeah, it'll teach you discipline. It'll break your emotions. Yeah, you can't trade emotionally, so you can't be emotionally attached to a puppy. So if you can't do that, right? No, of course not, dude. It's not. Money is not the issue. If money is the issue when it comes to like TRADARS, for example, then you got bigger issues than I can solve. Yeah. Money. It's so stupidly cheap. Yeah. Or you can check the website, right, Jim? Yeah. All right, so let's go back to this. It even acknowledges there's an uptrend. There's an uptrend channel, right? So how do you what does an uptrend channel look like, right? Well, oops. Right? It looks like up, 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 down, down, buy, up, 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 down, down, buy, up, 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 down, down, buy, up, 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 up. Okay? Great. We all agree that looks like an up channel. But how do you trade it? You buy this. Oops, come on, drawing tool. All right. You buy this, you buy this, you buy this. Does that make sense? Yes. So where people get confused, and don't worry, we're developing amazing amounts of training that will coincide with a TRADARS membership. But the thing is, it should be obvious, but I don't know. Some people are some people, right? Where they look at that and they're like, TRADARS told me to sell it. Well, let me be frank. That is dumb. It didn't say that. It doesn't tell you to buy or sell. It tells you there's an up channel. Why the heck would you sell an up channel? It doesn't make any sense. Well, it told me down. No, it told you it's in the down process of an up channel. You don't sell up channels. What are you? A ning cow poop? A gull of bull? Right? Dude, like seriously, right? You got to put a little bit of thought in this. If you think TRADARS is going to make you filthy, stinking rich, you're looking at the wrong service. This automates technical analysis. So really, the way you should, if you put any level of effort into it, you're like, ooh, I'm going to get ready to buy it. Why would you buy a higher low? Does anybody know why you would buy higher low? Because you're a bull and you see the uptrend. That's way different than like, I don't know, it told me to sell it. No, it didn't. Bro, come on. Come on. Seriously, come on. Yeah, right? So anyways, here's the thing. This is going to become a big part of your trading platform. And you are going to run your trading and investing business like a sustainable small business. You see, you're going to become a trader and an investor. And this goes back to like Stewie's like, how much it costs? Stewie, if you went back 10, 15, 20 years ago and you were going to start a hedge fund, like, okay. My annual compliance budget, and I was small. I was a peon. I did about $1 billion a month, which is small. And I spent about $200,000 a year just on compliance, Stewie. Just on compliance. So if you imagine back then, you started a Forex hedge fund and you hired a technical analyst to work for you, right, Stewie? And you're like, every morning or whatever, several times a day, I want you to show me what looks good technically. Go find me patterns that I could consider trading. Okay? What does that person cost? $100,000? So I think, let's say, if I charged $1,000 a year, 1% of the cost of hiring a technical analyst, that won't be as good as this, but they would do something, then it's fair, isn't it? 99% cheaper. Same thing with the, so like I have a macroeconomics degree from Harvard and a master's in financial management, also from Harvard, right? So what would you need to pay me to work for you to do this? More than $100,000, bro. So anyway, so again, if that's like $1,000 a year, I mean, it's so incredibly cheap. If you think about running your account like you're a small hedge fund, and you can do it, your whole infrastructure is something like $2,000 or $3,000 a year. Stewie's funny. Stewie, let me do it this way. I got it, Jim. There you go. Okay. So, right. So anyway, I have some amazing things that I'm going to bring to this. So I want you to first and foremost start looking at TRADARS as your platform. I'm going to help you build your Forex trading and not just Forex, all your trading and investing. I'm going to help you build the infrastructure for a sustainable business. And I'm going to bring more and more and more resources to you. And this will be your one-stop shop to trade more like an institutional investor. Yes, look, right? We have scalping tools, for example. So it's not just like, oh, it's all long-term nonsense. No. You can scalp, spot, swing, and trade on this position trade, but I'm also going to bring QuantBox into this. And I'm going to bring Investor Bootcamp into this. So imagine now you're running your trading business and you have consultants and coaches, right? Consultants and performance coaches. You've automated fundamental research. You've automated technical research. You have Traders Way, which is an amazing broker, all tied together. So you can run your trading like a sustainable small business that makes institutional grade decisions. And I want you to be a part of it. It'll take me many years to get to break even with the investments I'm making, but that's okay. I want you to succeed. Okay? And I have a dream in a couple of years. I want to get together. I want to have a conference. And every single person at the conference, so let's say 100 people, every person there will have been able to make the switch to TRADARS, and they are now in a career where their trading and investing is their main source of income. They are full-time professional traders paying the bills. And I'm going to get 100 people together and we're going to party. It's going to be so emotional if you think about it, like everyone has, found that success, achieved their dreams kind of thing. That's where we're going. So I want you to be involved. I want you to stay close. Okay? Yeah. Huge, dude. I'm telling you. All right. So let's zip around. Let's zippity doo-dah around. Let's start with dollar pairs. Dollar pairs. Oh, sorry. I went to the stock market. I guess we'll start with the stock market. Okay. Okay, we have stayed in the range. This is the range. I'll never. Okay. If I can grab this. No, still won't let me. No, that still won't let me. Come on, template. Come on, MT4. Oh, you TradingView guys are laughing at me. What a knucklehead. I know. I can't get it. It won't let me. Why is that just... You'd expect it'd be behind everything, right? I'll never look into your eyes. All right. Oh, but I got it, see? All right. So we're stuck in the range, eh? The big events are tomorrow, CPI tomorrow, and then the FOMC. Yeah, very cool. CIA, we're going to meet. I'll send out an email. I don't think we need 8 hours at this meeting. So I'm thinking 12 or 12:30 we can get together, review the performance of the portfolio, and have a general discussion of rotation, rebalancing, and maybe potential new investments. And then we'll get the summary of economic projections, and we can watch some of the press conference and all that kind of stuff. And then we can get together and have our open discussion, and then deploy some capital. We will probably we might consider rebalancing and rotating due to like seasonality. There might be some investments that we want to do with the cash. I think there's $3,000 or something like that, that we can also deploy, and we'll have to decide what we want to buy with it and where we want to put that cash. So, I think if we started at noon, we should be done, before 5. So I'll send out an email to the CIA. Does anyone want to join the CIA? You would need to do it today, because there's quite a bit of videos that you'll need to watch to catch up. Right. So you know how to just at least you need to start today. Otherwise, anyways, you got to get going. Nobody here wants to know how to build and construct a portfolio like a professional? Really? Nobody cares about this stuff? All right. I don't know where else you're going to learn it. I'll tell you that much. Okay, so I've been bullishly neutral on S&P. What I've been saying on NASI is I'm a bull here, and I'm a bear on the Dow. And I was going to draw this, but I think you guys know this, right? Okay. I think you guys know this. Can anybody confirm that I've clearly expressed looking for buying opportunities on the NASDAQ and selling opportunities on the Dow? Can anybody confirm that that has been clear as day? JP, many times? Yeah. Many times even today, right? Yeah, sweet. So, yeah. So that's cool, right? Because I don't know the direction, but I know how to respond. Yeah. So, Eskimo Maniac, you're going to join the CIA? That's cool. Yeah. Now, traditionally, what happens is you have to watch, I think, about 12 hours of training videos. And then at a bare minimum, I think it was 8 hours. Our first meeting back in November was 8 hours long because I had to introduce the portfolio and how and why I constructed it the way it is, and to go over every single investment. We go through the prospectus. And it takes a while, man. It takes a while, but you're like, oh, snap, this stuff's interesting. And it truly is interesting. But you got to go through all of that, and then you got to hear our discussions. And then I think that first meeting, I had 50,000 in the account, and I think I gave the team 10,000 to invest. AB says 12 hours of re-educating a race with gurus fed us. Well, this is professional endowment style portfolio construction. There's no gurus for that. You know what I mean? Like, you can't bullshit the institutional world. So like I manage 3 endowments. Yeah. Okay. YouTube gurus don't do that. It's just not the same planet. You know what I mean? Yeah. Yeah. So there's no YouTube gurus that do stuff like that. Yeah. I mean, like, let me ask you this, because I don't know. I don't surf YouTube gurus. You tell me, and this should be a basic requirement, but let me ask so I know. I'm asking you a serious question here. Of your trading and investing YouTube gurus, what percentage have at least been licensed and registered and passed the Series 3 examination and have had FBI background checks? That's like a basic entry-level kindergarten qualification. You've passed the exams, you've paid the fees, you've put up $30,000, $40,000, $50,000 in net capital requirements. You've had your fingerprints all sent to the government. You've had FBI background checks. What percentage have done that? What's up, Favor? You tell me. I don't know. Is it actually fairly common? I don't know. None? Anybody else? Hello? Yeah, I guess you're like me. Yeah. I mean, honestly, that's such a kindergarten level of requirement. Like no sophisticated investor, whether it's a high net worth individual or a small fund or an institutional investor or something like that, like it's like even assumed, like it's not even part of the due diligence kind of thing. Like it is, but it's not. It's not like it's impressive. It's so basic, it's assumed. So I don't even understand why these idiots are allowed to stream on YouTube. They're not qualified to do anything. Like, let's face it, in the real world, if you were running, a sophisticated hedge fund or institution, right? What percentage of these institutions are run by Ivy League educated people? It's very high. Why? Because it's hard to do that. There's a vetting process. The whole world has a vetting process, but not YouTube. So anyways, I'd be very careful. Yeah, I'd be very careful. All right. So anyways, look at the Dow coming down. Just like butter. Yeah, it seems like anybody can put anything on YouTube. Yeah, but why would you listen to somebody like that, right? When it comes to financial education, let's call it. You're like, good, so what's your financial education? And they say, oh, you don't need all that mumbo jumbo. Oh, really? Yeah. One of my favorites is fundamentals. Oh, you don't have to do any fundamentals. It's all in the price. Oh, so you don't understand fundamentals. Great. Probably a lack of education. Now, 44% of you are risk off, so you would be selling the Dow today. And you've had a really good 8 hours since the London Open. It's been down. You sold it off of the central pivot, right, which is the lower high in the channel I drew yesterday. Now, why did I draw it yesterday? So that it's today's plan. Remember, what I'm doing today is for tomorrow. Okay. And by the way, thank you for popping in the votes. It seems like pretty much everybody voted. I appreciate that. Thank you. It's good input for us because this usually represents the actual market. The more votes, the statistically better. You need at least 30 to make it a statistically relevant sample size. Okay. Silver's been, right? Okay, so why do you care about the Sharp more than the Sortino flash? Which one are you actually trying to get? But there's an easy answer to that. But let me ask you why you're trying to achieve a Sharp. I mean, just because it's... I mean, people look at the Sharp for sure, right? But it's a weak analysis. It's a weak form of risk-adjusted performance, because what happens is it gets influenced by bullish trends. So like for example, Flash. Okay, great. In an uptrend, so let's say the Fed is in the middle of quantitative easing. We don't do it anymore, but quantitative easing's dead. It's one of the reasons I'm going to the St. Louis Fed. When am I going? Is it next week? I forgot about that. Hey, if anyone is near St. Louis and you want to meet up and have dinner, or I'm going to this really cool, very classy cigar joint But I want to. Usually, I go to like an old school steakhouse, right? But I think I'm going to go look for some like St. Louis ribs, get some ribs, maybe listen to some jazz, and then I'll end my evening with cigars and a cocktail. Dude, if you want to meet up, let's meet up. And for those you're like, sounds good, but I'd have to fly. Well, at least for me, the flight was cheap. And then you're like, then I got to spend money on a hotel. Dude, the hotel was so cheap. I couldn't believe it. Okay? You could rent the penthouse for $500 a night. Oh my God. I looked at it, I'm like, I don't need a penthouse, but a room that's usually, let's say, $2,000-$4,000 a night, it's $500. Dude, gives you a sense. So I got they called it a larger corner 1-bedroom suite. I think it was $250. I mean, $250. And if you want to go, right? And you're like, even that's expensive. And you're like, dude, well, if that's the nice hotel, go to the Red Roof Inn. I don't know. But anyways, if you want to join me, and you want to we might be able to get pictures in front of the St. Louis Fed, and you can go to the museum. I'll be in meetings all day, but dude, if you guys want to meet up, let me know. Okay. Anyways, going back to this. Oof. We're at the bottom of the range here. Yeah. Now, I forgot what I was talking about, but before going to the St. Louis Fed. But anyways, I did want to discuss that. It popped in my mind. I'm like, oh, yeah. So stocks doing what stocks are going to do. Yeah, we were talking about qualifications or something, but whatever. Let's move on. We were talking about Sharpe ratio. Let me just cover that quickly. It's such an easy topic. So what I was saying is if the Fed is doing quantitative easing and everything is going up because the Fed is pumping money. Okay? Because the Fed is pumping money into the market. Dude, any idiot could make money. Because everything is going up because the government, in this case the central bank, is pumping free money in the economy. And why is the Fed doing it? To push up asset prices. So if you own an asset, which means you're rich, because you don't waste your money on crap, you buy assets, then you get richer. Why? The government is there to save you. Do you understand the game is rigged? Just ask Trump. He's like, of course I don't pay any taxes. The game's rigged. He's like, I didn't set the rules. I play the game. Those are the rules of the game. So anyways, of course the game is rigged for rich people. So why don't you just get rich? The thing is you have to act rich. So when the Fed comes in and does quantitative easing, it pushes up asset prices. So if you own a house, if you own a stock portfolio, if you own commodities, everything goes up. So your Sharpe ratio looks great. That's the problem with the Sharpe ratio. And Bill Sharpe, right? So Sharpe and Sorrentino worked together and created that particular ratio which went on to get named the Sharpe ratio. And won a Nobel Prize and all that kind of stuff. Great. But the problem with it is it shows when everything is going up, it counts that as volatility. Well, you don't want to count the volatility when things are good because it's a risk-adjusted performance analysis. So if everything's good and any idiot can make money in market conditions like that, then that's not really why would you do risk-adjusted performance and include when things are good? You're doing risk-adjusted performance analysis because you're worried about risk. It's not volatility per se, but how does this manager or this asset or this portfolio, how does it perform when things are bad? That's what people care about. So Sortino got mad at Bill Sharp because Bill Sharp, well, it became the Sharp ratio, but Sortino worked on it too. So somehow everyone called it the Sharp ratio. So Sortino gets shunned, and then the Nobel Prize, and Sortino's like, whoa, how about me? Right? So anyway, so he does a Sortino ratio, and all he does is he takes the Sharp ratio and he tweaks it to say, we don't care about the good vol because any idiot can make money. Who cares? It's stupid. But when the shit hits the fan, who's going to survive? You understand? Yeah. Who adjusts most quickly? Who hedges most quickly? Who has the least amount of bad volatility? And that's Sortino. So anyways, to start with the process, what you want to do is have, I'll put it over here, lots of small losses. Okay? And how about several, so more than a few, several big winners. And you do that by letting your winners run. Okay? Okay? Yeah, well, be careful, Richard. Bill Ackman has also made lots of really stupid decisions and has lost huge amounts of money for his investors. So don't overdo it. He's done some good things and some smart things, and he's definitely not an idiot. I respect him. But be careful. Like in some of my Harvard case studies, I'm surrounded by 20-year-olds, right? And they come out and they say things like, "Oh, the guy from Netflix, he was a genius. He put Blockbuster Video out of business. He's a genius." And I'm like, dude, bro, I was there. He was not a genius. Okay? At the time, it was common for those in the Silicon Valley, which were a little more tech savvy, that we were sharing files for movies. And you're like, hey, man, do you have Fast and Furious? I don't even know what was out back then, right? I don't know, the Will Smith one with the aliens or something, right? Hey, do you have such and such movie? You're like, yeah, I got it, man. It's on my server. Because if you live in the Silicon Valley, you had a server in your house, right? And you're like, oh, could you rip that for me and burn it? Yeah, I'll burn it for you. And you'd burn it on a CD and you'd share it with your buddies. Wasn't it genius? Everybody was doing it. So I get mad at these millennials that worship stuff that just don't understand. So I get all pissy. It's not you, Richard. It's me. I'm the weird one where you're like, Bill Ackman's a genius. No, he's an idiot with a lot of money. Right? And the media tends to overinflate reality. And it's like, okay, he's not an idiot. But there's like, for example, was it Paulson? John Paulson? Hank Paulson? No, John Paulson. Anyways, the guy that made a whole bunch of money shorting the real estate market during the 2008, 2009. He made a boatload of money. Great. So he's a freaking genius. Then he took all the, and then he closed the fund, started a new fund, threw it all into gold, and lost his shirt. And the fund lost everything. He bought gold and gold mining and gold this and gold that because he was able to sell a fund. So he then went to, rich people and said, hey, I just made 1,000% shorting this, that real estate market. So now I'm going to start a gold fund. You should get in it. So everyone invested. But the thing is, that's not why you invest. And also the second thing is the way he made 1,000% was degenerate gambling. And I do not respect that. So that's not what Bill Ackman did. But I'm trying to show that a super high performance, more often than not, is a sign of stupidity. And yet the media goes, this guy's a genius because he made so much money. No, he's an idiot. Okay, so then going with Bill Ackman, he's made some huge mistakes, but we tend to forget all of that. He made huge mistakes. But he did a lot of really smart things. And like COVID, he did well, where he didn't dump his stock portfolio, but he made a big, he used options to hedge it, and he made a boatload of money using hedges to make money if the stock market fell, and it did, but he didn't cash out of his cash position. So then he made like, a couple $100 million on the options trade. And you remember that it only dropped for like 3 weeks or something. So in those 3 weeks, he made a couple $100 million on his multi-billion-dollar portfolio, which lost money, but then he took the $200 million and then he bought the stock market low. And then, of course, we all know within a week or two, it was back to where it was. So his cash position was protected. And then the cash position went back to where it was. So nothing actually happened. The net asset value returned. But then he owned $200 million more. And then that went up and he doubled on those. Because, if you buy, one of the things I was interested in was Carnival Cruises, and it was like $4, and then it went back to $25 or something. Boom! So you just blew the doors off of that, right? So, anyways, be careful. He's smart, but he made mistakes, and just because they made a lot of money is not a sign of genius. Now, going back to the Sharpe ratio, what you want is lots of little losses, and then when you're right, let the winners run. You'll have a good Sharpe ratio, because you'll have low vol when you're wrong, and when you're right, you're very, very right. So you have a lower vol on the downside and a higher distribution, right? What you call it is you have a fat right tail. So you have lots of little, right? How would I even draw this? I don't know if I can draw this. Okay, so you want a fat tail. So here's the distribution. And I think it would look like this. Very flat tail. And here's all your little losses. And most of them are low losses. So most of your losses are in here. -3, -10, -12. And some are a little bit bigger. But then you have something like it drops much quickly, but then you have this. So your winners are bigger and bigger and bigger, and like that. That's not quite right. But anyways, what will happen is your volatility is low, and then when you catch trends, you let it run. So your average profit is high, your average vol is low, and 66% of these are a loss to zero. Somewhere between your biggest loser shouldn't be much and up to like -3. And then your average run should be, 100 to 300. And your average loss is, let's say, 33. Okay. And it produces, right? It produces. So that's great. But Sortino says, ignore the upside and only worry about the downside. So in my portfolio, it's designed to be low volatility. And so its Sharp is only approximately 1. So I perfectly get paid for the risk. And that's by design because it'll underperform on the way up, it'll overperform on the way down, meaning it'll lose less money on the way down, but it'll not make as much money on the way up, and that's by design. So my volatility is crazy low, right? So a Sharp just tells you, okay, it's performing the way it was designed. But what was it designed to do? Okay? And so that's where you take this Sortino, and it doesn't look at the upside. It only looks at the low side volatility. What happens when the market is doing poorly? Okay? So my Sortino, is another measure, and it's a 5. And that is astounding. So to an institutional investor, like, okay, a Sharp, so he's market neutral, but I'll way overperform the market if the market collapses. And so now an institutional investor will say, all right, well, I don't know. Most of the time it's going to underperform. Do I want to do that? Well, it does protect me during the bad times. So if they were worried, they'll take the Sortino. But then they might pass and say, well, I'm risk on, and you only got a Sharp of 10, of 1. So you're like, I can do better than that. I'm like, oh, well, I have a Sharp of 1, but you're earning 10% cash every year. And the volatility in this Sharp of 1 is negative 40 versus the 1. So you can buy the S&P 500, but I have 40% less volatility, and you're going to collect 10% cash on a 1 Sharp and a Sortino 5. And they're like, dude, that's impossible. That's really what people say. They're like, no, that's BS. I'm like, yeah, well, I've only been running it 6 or 7 months. You're right. It probably is just random. So why don't you watch me continue doing it? You let me know when this becomes believable. Meanwhile, you'll miss out. You can just watch me do it. Watch me do it, bro. And that's what you learn at the CIA. Like literally what we did at the CIA in the first 6 minutes is truly unbelievable. Institutional investors won't believe it. That's going to be the hardest thing. If I went to an institutional investor and said, this is what I'm doing, I want you to put money in, they're like, those numbers aren't believable. I'm like, what do you mean? There is no way you can have less volatility, 10% income, a Sharp of 1, and a Sortino of 5. No, that's impossible. Seriously, that would be my major problem. And I'm like, well, why don't you audit it? No, I don't want to waste time on that because it's truly unbelievable. Yeah, okay, yeah, well, I'll hit you up in a year. I'll come back at you in a year and I'll show you. Okay. Well, Flash, your Sharp, people look at all the time. So, like, if you're going to run into an investor, they're going to look at your Sharp. That's the thing. The first thing is like, well, what's your Sharp? And you're like 1.8. And they're like, ooh, okay, cool. Okay, so, but it changes over time. And so if you come at somebody, you're like, well, I got a Sharp at 3. And they're like, over what period? Oh, well, 3 months. Yeah, whatever. Okay, and then they don't care anymore. All right, so you got lucky over 3 months. Great. So the Fed is doing something to create a trend, and you caught it. Great. But what it doesn't tell you is when that trend stops, how long does it take for you to change your strategy? See, that's what institutional investors care about. At some point, they really don't care about your positive return. So you say, oh, well, I'm up 30% this year. Okay, it's sort of interesting, but it's sort of not. And they're like, okay, whatever, let's take a look at what you're doing. And that's what it gets to. And you're like, okay, so you're up 30%, but you started trading in January, and you did one thing, basically, and it performed well. Great. The other thing is, well, how'd you get 30%? The stock market's up 15, and you're up 30. Okay, let's take a look at it. And a couple of things could stand out. You could have a whole bunch of losses and one giant winner. Oh, well, how repeatable is that one giant winner? Are you going to get that giant winner 6 months from now, 9 months, next year, in 3 years from now? How many giant winners are you going to get? So they're not interested because what they're trying to figure out is, at the end of the year, what's the probability of you consistently producing a certain return? And then what's the cost? So you're like, okay, you generated 30%, but you're using, let's say, 150% leverage. Oh, well, again, what'll happen is, in periods of doing well, your Sharpe looks good, but in bad periods, you're also going to lose a lot more than everybody else. And so it'll come out like it'll be a bad Sortino, and probably not even a good, depending on how you trade, it probably isn't even a good Sharpe. But like I said, if you kept all your losses really small and you had a higher percentage of good trades that you let run, we should be able to see that when we look at the individual trades. A third one is that I see this a lot is they, let's say 10% or 90% of their trades are really not that good at all. They're not bad, they're just not good. They're mediocre wins, mediocre losses. And then there are a few winners every now and then where you double and triple your lot size. So once again, you're using leverage to cover up your mediocrity, and a sophisticated investor is going to see that, and they're like, hard pass, not interested. And by the way, just out of, I don't know if you're interested in this, but there used to be copy services, where you just pay some money and it places the same type of trade and all that kind of stuff. And there used to be 3 or 4 really big services. I don't know if they still exist or not. I don't know. But I downloaded the history on about 1,000 of these guys. And every one of them was profitable. I didn't download the history for the losers, obviously. And I analyzed them. I didn't find one worth investing into. The whole entire industry was bullshit. Tens of thousands of bad traders and 1,000 profitable traders. And of the 1,000, none of them even compensated you for the risk. They couldn't even get a Sharpe of 1. Right? Amazing, right? Yeah. So, well, the blind leading the blind, huh? Big in pips, not. Yeah, yes. You don't. I'm answering the question. Big in pips, you mean not in money relative to the account size? Correct. That's the thing that they're looking for as a risk. Okay, so it's an immediate thought process. Okay, Flash. where somebody says, hey man, my account's made a lot of money. The first thing that pops in their mind, what was the cost of that? Because if you have big lot size and you win, you have a high return. But let's say we all believe it's easier to lose money than to make money. Let's say that's a basic tenet, that losses are normal and expected in our business. But when you lose, you will lose a boatload of money because of your risk size, your lot size, your leverage. And therefore, the probability, the risk of ruin is extremely high with your form of trading. So you're like, well, I did really well and I made a lot of money. But then people will look at what you do and you're like, oh, dude, it's almost a certainty you're going to have a big drawdown one day. And nobody wants to be a part of that. Okay? You're like, well, I'll make you 100%, but I might lose 50%. People with money are not interested in that. You're like, well, I'll make you rich. Well, dude, I'm already rich. My fears, I'm not interested in dreams. My fear is I give you money, and one day I wake up and I get a phone call, and you're like, hey, man, it's Flash. Guess what? I lost a whole bunch of your money, and now I find out I'm poor. Do you understand how frightening that is to a rich person? You're like, wait, what? Say that again? Oh, yeah, you're poor. Sell the house, sell the car, sell the wine, sell the vineyard, sell the jet. I had a bad month. Oh my God. Right? How frightening is that? So I'd say the biggest mistake for a new fund manager, in particular one that grew up like a regular person, they go to somebody rich and they say, hey man, I run a Forex fund. I'm up 50% this year. You just ruined it. You opened your mouth and you talked like a poor person to a rich person, and they don't like it. Okay. So like, when was it? A year or two ago? Right? There was a situation where I had a Sharp of like almost 3. And the guy called me up and he's like, holy shit, dude. You're pulling a 3. And I'm like, no, I'm not. He's like, I'm looking at it. We ran the numbers. You're pulling a 3. I'm like, no, I'm not. He's like, you are. Like, why are you saying that? I'm like, don't tell anybody. Because it was over a short period of time. I'm like, don't worry about it. It's not going to stay there. But you that's how you want to talk to people. Like, they're freaking out. You got a 3. No. Shh. No, don't worry about it. Right? This too shall pass. But what is killer is a Sortino. Because it looks at how do you do when things are bad. And they look at that and they go, oh, wow. So you can get a pretty good Sharp if you're lucky. But you can't be lucky when things are collapsing. Yeah, and society is going to shit, but you're calm. And, well, it's because I baked it into the construction of the portfolio. Yeah, it's all by design. And that's the uniqueness of what we're doing over at the CIA. Nobody's seen anything like this before. They're like, people won't believe it. Yeah, people won't believe it. Oh, I lost my oil trade. Come on. Oh, I might have to bail on that. I might have to bail. It's so little, but I'm going to come back to it later. I don't want to watch this. I'm just going to take a small loss on that one. Should I not do it? There we go. I'll do this one. Ugh, it's only a couple of cents. I don't want to watch it, though, today. My other one is still way below. Too bad. I caught it on that bottom, but I don't want to. I have to pay attention, and I don't want to pay attention right now since I'm doing the live stream. But I might pick it up closer to. It might drop $1, and then I buy it back. But I'm still in this one from before. All right, and we're still in the range on gold. Okay, popping back up as I talked about yesterday. Silver, not a lot of love for silver right now, but we're still in the middle of the buy zone, and it's just it's just not performing well. We have that. Right? We have that there, but then we have this here. And I don't want to make it too tight. Like, I don't want to overstate it. So, we have a long ways before the apex. Flash, if you had a 10, you have a lot of explanation. So, like, about 2 years ago, my buddy was in a problem, right? He ran... another Forex fund. But anyway, so he got like a 9 or 10, maybe as much as 10% drawdown. And we were talking about it. He called and he's like, "Oh my God, I got to make the calls. And I'm like, okay, yeah. And it's the worst, right? So he just had to talk to someone that understands the pain, right? And he's like, I got to make the call. We're down 9. We're going to hit the 10 handle, man. And I'm like, ooh, whoa. And he's like, yeah, well, this happened and that happened. I'm like, I get it. No, I get it. But you got to make the call. You got to call the clients and say, hey, man, we're down 10, but don't freak out. And, oh my God, they're hard phone calls because you're also attached emotionally to what's going on, and you don't want to lose the clients, and your clients, right? So like you've had dinners, you've courted these investors, and sometimes it takes you 2 years to close a deal, especially like a family office, right? And so and you might have brought in a new client just a couple of months ago, and then you'd have other clients that have been around years, but you got to make the call, right? You're like, hey, man, I just want to let you know we've hit a rough patch, and it had to do with this, that, and the other thing, but I don't want you to freak out. And it's horrible. It's horrible. It's horrible. If you hit 20%, they're gone. They'll never take your phone call again, ever. They'll pull the money, it's called redemption, and you're dead in the water. Now, the reason you're dead in the water is you're going to lose your current clients. But in the United States of America, you also have to report your track record over the last 5 years. So when you go to somebody new to replace the clients you've lost, you have to say, hey, I lost 20%. Do you want to invest? They're like, son, why are you wasting my time? Why am I here? I made a horrible mistake. And boom. So here's the thing. If you lose 20%, you will lose your clients and you will not get any new clients. So you've just ruined your small business for at least 5 years. So you'd probably have to close your fund, give all the other money back. Because I don't know, if you lost 50% of your clients, do you even make enough money to be worth it? Like, you're a hedge fund manager during the day, but you Uber at night. You do Uber Eats. You deliver pizza at night, but during the day, you're a hedge fund manager, right? You're like, well, maybe. But you might have to close your fund because they're expensive to run. So you have to wait 5 years and then start a new fund. So that's at 20%. And then you look at a lot of firms that are quote unquote good on these like copy services that I looked at before. And, you know, they'd have drawdowns way more than that. And you're like, dude, this guy doesn't know jack. Okay. Yeah. And that's the thing. So last month, you guys, the video's on YouTube, but last month, several members of Investor Bootcamp expressed their challenge with pulling the trigger. And I said, okay, so I'm going to pull the trigger more this month in my example trades. Trading mini lots on a $30,000 account, right? Yeah. Well, in a week and a half, I was up 10 to 12%. So that's good, right? No. And like I said, it's on YouTube. You can watch the video. It's bad. It's really bad. And what it shows you is if you only have $30,000 in your account, you shouldn't be trading mini lots. Now, some of you guys have 5,000 and you're trading multiple mini lots. And I'm like, dude, ridiculous. It's so dumb. And so you'll say to me, well, I can't make any real money because, because they're small. I'm like, no, your trades suck. That's the problem. If I were your boss and you had a $30,000 account and you make 10% in a week. Now, okay, you know how to trade. There's no doubt about that. But the problem is your lot size is way too high. So I would reduce your lot size. And I mean by a lot. So if a 5% month is massively good, and I'm happy if you're doing two or three. So if I say 2 or 3, some months you're going to do 1.5, some you'll do 3. So you'll average closer to 2. Dude, 2 is good. 3 is astounding. So and you want that over a month. So if I dropped you to 3 micros, you're still possible to do 10% in a month. And I'm like, 10% in a month? Holy crap. What are you talking about? So I get to the point where you should be able to do this on one micro lot. You're like, 1 micro lot on 30,000. Yeah, well, if you let your winners run, that's where you make your money. Your trades are worth more. So if you guys recall, and just again watch the video, I pulled the history up on MT4. You see it. I think my average loss was 33. And that makes sense because that's what I teach you. My average winner was like, what was it? Almost 400 pips. So what do you think? I had a good Sharpe ratio? Yeah, of course I had a good Sharpe ratio. But the biggest thing is, it was absolutely apparent I was way over leveraged. And it was a bad message to you. I don't want to show you Like, hey man, I can make 25% in a month. They're like, dude, that is a bad message. Now, maybe it would be good for YouTube, but my intent isn't to be a YouTube star. My intent is to help you build your trading into a sustainable business so you can take care of yourself and your loved ones. Because I'm convinced, like, I know professional money managers. I'm a client. I've been a client of professional money managers, I don't know, 20 years or something. So I know multiple firms and all that kind of stuff. I've been through multiple crises, financial crises, and I'm 100% convinced nobody's going to take care of you. If the shit hits the fan, they are not going to take care of you, even though that's what you think you're paying them for. The industry is not even designed for that. That's the sales pitch, but it doesn't even work that way. So I'm here so that you can take care of yourself, which means your money, your family's money, and then you take care of your loved ones, your spouse and your children. But then you can be around to take care of your community, your friends, your family, your church. You're like, people are going to turn to you for help, and you're the only one. Okay. Cool. Favors like, what's the number of your 8th moving average? That's just the difference between the 21 and 55. So the first one's 21, the last one's 55. See? That's all. No big deal. It's nothing. It's nothing. It's just another way of looking at things. So that's my goal. So I hope you hear the message. I don't know if other people give you this level of granularity and detail, but this is what you're going to need if you're going to survive this thing. Sure enough, look at the bounce. Sure enough. Anyways, I had to do that because I don't have time. So yes, very obviously it would probably bounce there, but I can't babysit that and coach. Every so often things will collapse on me while I'm coaching, and I'm done an hour and a half later, and then I go look, and I was just bleeding cash. I'm like, oh, shh. So I'd rather just get out and come back during my coaching. S&P is on our line, and it is holding. That's very interesting. I want to isolate PIG. PIG has a reasonable opportunity, and we're coming up to a 4-hour 21 and a neat little roll reversal, and that looks like could be interesting to me. Now, why would I care about something like that? Because I already covered this hours and hours and hours and hours ago. And I did upload it. And then also what I did is I uploaded, I don't know, like 10 videos this morning. Just catch up stuff. This is, 4 weeks ago, 3 weeks ago, 3 weeks ago, 2 weeks ago, 11 days ago, 2 hours ago. Anyways, I've been busy or lazy or something in between with uploading the videos to YouTube. But the thing is, people on YouTube are free to watch it and learn how to do fundamentals. But why don't you just pay the money and join us live? And of course, the recordings are in QuantBox, but like, you should watch some of these and realize you're probably missing a boatload of stuff when it comes to trading properly. Like, these fundamentals should blow you away. And go ahead, like, look, honestly, this is what I would do. I understand I'm strange, but I want to be strange. I would never want to be normal, right? So I am strange. And so what I would do, and these are about an hour each, right? Sometimes longer, sometimes less. So let's say they're about an hour. Watch the last 10 videos. 10 to 12. Just watch them. Watch them all. Watch 3 a day, 5 a day. And decide for yourself, are you ready to change? I think many of you think you do, but you're not. You're going to come in, you're going to play with it and leave. Watch them. Spend the time. Quantbox is, what is it, $79 a month? Like, dude, it's pathetically cheap. Okay? Cool. So watch 12 of them and then make a decision. Stop trading like an amateur. That's your decision. Do you want to keep trading like an amateur, or do you want to stop trading like an amateur? And then you sign up when you made your decision. And I think if you were willing to put in 12 hours of just watching this, I think you have a chance. You have sort of an ethic that will lead to your success. Yeah, that's what I would do if I was me. Cool. So anyway, yeah, we do this every morning. All right. So anyways, so why, the question was, why this? Well, I discussed it here. All right. Good morning. It's 7:02 on Wall Street. About 2.5 hours before the open of trading. It's time to get your global macro on and uncover the best fundamental risk off in the money market. This is subjective. You could argue and say, oh, it looks pretty round, so we're neutral. Look at all these pretty colors, huh, bro? Bullish. It's already... yeah, it could fall. Just in a normal year, it could fall almost 2 months. Up there. Look at this. We do this every morning. Like said, dude, look at all this detail that we do every day. On the 5th, it was an 8. On the 7th, it was a 3. And on the 8th, it was a 0. Whoa! Now, Simon said, would you sell it with a -1? Well, that means there's more things bearish than bullish, but you could also be selling the change in direction. But yes, if you wanted to be a purist, so to speak, if you wanted to wait until things are macro bearish for euro dollar, then yeah, you could. Yeah, you'd wait. But you could also anticipate. So Simon, when I say France over the weekend put itself into a political nightmare, and one of the largest economies in Europe is going to be probably at best stagnant, but not just between now and the snap election, but based on the almost certain outcome, they're going to have a hung parliament, so to speak, for the next 2 to 3 years, because they'll have a president and a prime minister from radically different parties, which means nothing is going to get past them.
Like, look at the details we're talking about. Like, dude.
So this one, I mean, like when I bring everything to TRADARS, that you'll have like a coaching staff and a performance, right? A performance coaching staff and a staff of consultants. They can help you understand fundamentals as well as technicals and address trader psychology. This is what you would have. Like, think of it. Like, how many people here have watched Billions? Okay. Right? Where you have a performance coach to help you with the psychology, right? And they're all doing fundamental research and technical analysis, and then they have multi-layers of bosses, and it'd be like, dude, you're Axelrod, and you have this huge team and staff working for you. Like, dude, I'm going to make you Axelrod. And you're going to be, TRADARS is going to be your personal cap axe. Axe cap. Axe capital. That's going to be you. It's going to be you. Oh, but it's going to cost you, $150, $200 a month. Oh, well, forget it then. I'm out. It's so funny. All right, so you'll have to watch that video, okay? And Swissy is another beaut. Oh, crikey, she's a beaut. So QuantBox, for a couple of weeks, has just been hardcore take this down attitude. And I guess we could bring it up. Do I even have it open? I must. I usually do. Where's my QB? QB. There's one over here. All right, QB. I think I'm still logged in. Cool. And we're looking at CAD Swissy. And we want to go to, let me expand this. Oh, this is the iteration where the browser failed. All right, let me bring up the other one. This one I think is from this morning. Let's go to the backtester and expand it. Boom. And then what was it? CAD Swissy? CAD Swissy. All right. So we went negative. Well, it's been negative the whole period. May 12th and then accelerated May 31st. Okay, so negative the whole dang time. Let me kind of zoom a little bit. And that's what's happened. So you see here on May 30th. Okay, it went from -1 May 28th, the next day -2 on the 29th, and then -5, -6, -9. So in the last 3 days, starting May 30th, QuantBox went hardcore bearish on CAD Swissy. So what was that I said? The 30th. And that is here. Oh, that's still the 29th. Hang on. On the 29th, it was a -2. Boom, right there. Okay, that's when, and notice technically what happened here. Technicals are only a small part of it. And of course, that's what I like about TRADARS and QuantBox. I agree with it for completely different reasons, right? like the 2155 cross. I'm a bear. A lower low in a fading bullish market. Yeah, like I see it too, completely differently. This is looking at much more than just the chart. But on the same day, went hardcore bearish. Hardcore. Boom, shalakalaka. And that's what happened. Huh? Yeah. That's cray-cray, isn't it? It's cool, isn't it? I think it's way cool. And the fact that I can just go back and show you. Yeah. I mean, right? The transparency. Both QuantBox and TRADARS have transparency built into them. So you don't have to take my word for it. It's built in. Trust but verify, huh? So euro's a disaster. This could come down a lot. Pound dollar hanging in there. There's still some maybe, but it's looking very weak. But I'll show you what my eyeballs are doing. My eyeballs are eyeballing this, which is already drawn. And then, of course, just the standard operating procedures by this dip. So with the UK, with rising unemployment and falling wages, as we saw earlier this morning, this might be all right. Bank of England could cut. Going back to the genius thing, you know who I did like from that early period is the guy that started Waste Management. And he was a kid working for his uncle who owned a garbage truck route. So he worked for his uncle as a kid, like high school kid. But then he saw like all these routes were owned by little independent garbage truck people. And he's like, ooh, we need to consolidate this. We need to have one company that owns all the routes, makes all the big money, but then can control all the costs of the business. Where if they're all run by mom and pop shops, you know, they're not going to be sophisticated. They're not going to have good technology. They're not going to have good management and all this kind of stuff, right? And you can have one mechanic working on 1,000 trucks versus one mechanic working on one truck, right? So he's like, So he ends up doing it. He ends up consolidating and creating Waste Management. So like after doing that for 20 years, he sells it, becomes a billionaire. So then he takes that money and starts Blockbuster Video, runs it. And you're like, oh, well, Blockbuster eventually failed because of Netflix. Yeah. Well, that guy sold it by then. So he starts Blockbuster Video with his billions and makes billions again on the IPO, right? And then exits, buys the Miami Dolphins because he moves to Florida to retire. And he's like, what am I going to do now? I don't know. Well, I like football. So he buys the Miami Dolphins, and this is like the 80s, right? And all of a sudden, like, the Miami Dolphins were like one of the most cool
teams in the NFL, and he's got celebrities going to games. He's just loving life and living large, and puts a lot of money into the team. The team's doing well, right? Remember Joe Montana? Not Joe Montana. What was the guy's name? The quarterback. Super celebrity quarterback and everything. And oh man, and then he sells the team and makes billions. And you're like, dude, the guy starts 3 businesses, and every single one of them makes him billions in profit for himself. I'm like, dude, that's the kind of story I like. Yeah. Right? Laces out. Nobody remembers that guy's name. What was it? I have Montana stuck in my, but that's, of course, the 49er. I can't think of his name. Anyways. You're like, man, I was born in 92. Yeah, all right, cool. Well, whatever. So anyways, there's some still up here, and then I'm wondering if the pound is going to benefit from the economic data that we got today. That's what I'm talking about. Higher unemployment and falling wages could allow the Bank of England to cut. Not next week, but maybe early in the fall. And in that case, maybe that's good for the economy. Take some of the pressure off. Ease up on the brakes a little bit. You know what I'm talking about? Dan Marino, thank you. Galactic, yeah. There you go. Laces out. So anyways, yeah, like, dude, the guy's a superstar, right, at that time? Superstar. So, anyways, so that's the world according to history. That's my story. I'm sticking to it. I got to go. This was real. Remember, if you're in my day trading group or my swing trading group at Investor Boot Camp, we meet today and we're going to download and report and read economic reports. And you're like, man, that doesn't sound sexy. No, but it'll make you rich. Well, maybe it won't make you rich, but it's the type of work that will distinguish you, a professional from an amateur. Now, you don't have a macroeconomics degree, but I do, and I work for you. You're my boss. It's a whole $99 a month. And this is only one thing we do. Yeah, so I work for you. You're a small business. You're a small, independent, institutional investor. And you have a Harvard degree working for you. And we're going to download and read the economic reports. And I'll do my best to explain it in simple terms. And you have an opportunity to ask questions. But the most important thing is you are habitually reading the actual reports, and you don't rely on a blogger for your opinions. You don't rely on TV personalities or idiot YouTube gurus for your opinions. You actually read the reports and you think about it and you say, I know where I stand. And imagine if you were actually raising money for your fund and you can say, wow, when I was reading the recent summary of economic projections by the Fed, I noticed something very interesting, and it was this piece of data that they talked about, but oddly enough, it was quite different from the actual report. So when you, let me make up a scenario where you're like, okay, they talked about certain types of inflation in the summary of economic projections, but when you actually read the PCE and you go through the subcomponents, you actually see quite a different reality. So you see so how are they making these jumps, these leaps of faith, where they have such and such opinion, but in reality there's something quite different? Is it a guess? Are they changing their model? Are they looking at core or super core? How are they making this? Boom. Okay, so if you had a conversation like that with a potential investor over your steak dinner and you're like, wow, I found this in the PCE subcomponent while you're doing your research, but then the Fed said something different. And the guy's like, wait, or the gal, she's like, you read the subcomponents of personal consumption expenditures? Yeah. And you download and review the Fed report and going through all the summary of economic projections? Yeah. In fact, I have software that will graph out their projections 18 months in advance. Really? Yeah. I know everything. Dude, you're going to raise some money because nobody's got that. So you're strong, you're tall, you're thin, you're beautiful. You got a wonderful wit and a beautiful smile that sparkles. And that's cool. But dude, you are informed and your decisions are wise. And people love the fact that if you're going to manage their money, that you geek out on this stuff and you do the work way beyond everybody else. And that's why they invest. Do you understand? You go up and you're like, I make 35, 40% a year. And they're like, oh, okay, you're taking a little too much risk. I make 50, 70, I make 80% a year. Okay. It doesn't wow people. It doesn't wow an informed investor. They've seen people like you before. They've made those mistakes before, right? If you go in like, give me some money and I'll make you rich, dude. Fail. But when you slowly reveal that you do better work, that what you do is a craft of information, you have more and better information than everybody else. That's what gets you the client. So you have a beautiful smile. Great. What they want is reasonable returns with as low risk as possible, the type of returns that they could almost count on, like a coupon payment from a bond or collecting rent from an apartment building. You very consistently, with very low risk and very reliably, pump out a reasonable income for your client. And you can do it because you're way, way more informed and you do way, way more work and better work than anyone else they have ever seen. You are what they're looking for. You are the hero. And getting rich quick, to me, is not a hero. So when you see a hedge fund manager that made 1,000% because he bet everything on one idea, that guy's an idiot in my book. Degenerate gambler to the nth degree. You are a money-making machine. There's a big difference. Peace on earth, may the pips be with you, may our profits be above average. I'm always around. Stick with me, stay close. We'll make a difference.